Well, joining me now with more is Jim Thorne. He's a chief market strategist at Wellington Altus. Jim, it's great to have you on the show this morning. And what are your expectations heading into this Fed decision?
Well, they should be cutting right now. And my thesis is that the Fed should be at neutral, which is about 275. When we hear Powell talk today, he will not justify that the Fed funds rate is 433 and that quantitative tightening is still going. There is no justification for him to be that tight. He will give you a communication strategy that implies that he's at neutral, but he's not. So he should be there. They should have been cutting rates to get it to that neutral rate, or what we call as an economist R star.
How do you determine that that is the neutral rate, your particular rate of 275?
I follow the New York Fed model, which basically says that it's around somewhere between 275 and 3%. So, and you know, when you look at it, you sit there and go, why wouldn't they be cutting? Because think about it. If we cut today, we're not going to feel it for 2 years. People assume that a Fed cut today will have instantaneous impact. People assume that a Fed cut is like a fine-tuning instrument. It's not. It's blunt force trauma. The other thing I would say to you as an old economics professor, tariffs are not inflationary.
Why is that?
Because they change the relative price structure. Let me give you some. So the U.S. is a service-based economy. Between 70 to 75% of the economy is service-based. 14% of the U.S. economy is imports. 1.5% is imports directly from China. Now think about all the fear and the hand-wringing over if we were managing a company with such a small portion of our gross domestic product exposed. So typically, you know, if you said in your first year economics class that tariffs were inflationary, you'd get the question wrong.
Interesting. So we have heard, though, from small businesses and particular CEOs that it is challenging for them to navigate this environment because of the uncertainty that is out there as this corporate earnings season is underway. How do you expect then, if rates do stay steady, that to impact the economy and thus potentially corporate America?
Well, you're seeing it, right? Southwest earnings, right? Pepsi's earnings, Chipotle's earnings. You're seeing the top line, the sales, the economy is starting to slow. So they're going to be late. Rates are going to go lower. They should be doing cutting now. Powell owns this. And so the term that I always say when I write is they're incompetent. Because I just gave you basic economics. I don't know what they're looking at.
So he has repeatedly said, Jim, we've heard it, obviously, that he's data dependent. So what data do you think he should be looking at that he's not seen to make these decisions?
Well, the five-year forwards, when I joined the business, that was the inflation expectation number. That's 2.18% below 225, the long-term average. Look at the 2-year, the yield on the 2-year. It's like mid threes. Look at the 2-year in Switzerland, negative rates. We're going back to a low-rate environment. Powell owns this. Powell, in 2 years, if he's not renominated by the president, is going to be long gone and sailing in the Chesapeake Bay. And you and I are going to be dealing with the fact that rates are going to be close to zero. And the Swiss data is telling us that.
Interesting. So what does this mean for markets? What should our viewers prepare for with the expectation that he keeps rates unchanged and the next rate cut doesn't come until July based on what the futures are telling us?
So we're going to have slow growth, and that's going to happen. We have a massive aha moment in front of us, right? And what is the Fed going to do? Are they going to wait longer and start cutting 50? If they do, I don't know if the market's going to like that or not. They're being very reckless. They're being imprudent. And so that's the type of thing that I just don't understand what they're looking at. For example, the beige book is more dovish today when it came out in April than it was in September, and they cut 50 basis points in September. 9 of the 12 regions reporting had data flat to down. That's 75% of the Fed's own regional areas pointing to a slowing or declining economy. Not my data, their data.
So you do not, I just want to clarify, you see slower growth, but you do not see a recession because there are questions and this uncertainty that's out there, stagflation, recession.
Yeah.
Where do you stand?
So I've always been slow growth, right? And a growth scare. In my career, we need to have a massive shock. So 9/11, 2008 global financial crisis, COVID, those are the type of events that you have to get a recession. Having such a small portion of the economy exposed to tariffs, I know people are going to freak out when I say 14% or 1.5%. Slow growth. It's not big enough to basically tip the economy into a recession.
So another question that our viewers want to know, right, the $1 million question, is the low behind us in the market?
I think so, yes.
We've heard, well, a lot of people have agreed with you of that lately.
And you look at, so I anchor off of the credit markets. And the 2 years telling you that the Fed's behind the curve, they're going to cut. They should do it now. If they do it in July, if they do it in July, it'll be 50 basis points. And they'll be way too late. And then interest rates are going to decline into 27. We got oil below $60. Yeah. So we've got all these deflationary Why isn't anybody talking about the counterbalances between oil going down and gasoline at the pump going down? Remember when we had everybody in front of the gas station when it was, $100? That's a counterbalance. We're going into deflation.
All right, Jim Thorne joining us with a preview of that Fed decision later today. He's a chief market strategist at Wellington Altus. Jim, thanks so much for joining.
Thank you so much.
Yep.